It was the first day of winter, but trading on Wall Street suggests that we have a red-hot market, at least for one day, as the S&P 500 and other indices were up well over 1%. In the case of the Russell 2000, up nearly 3% in its case. So a big day across the board. In fact, other than December 7th, this was actually the best day for the S&P 500 since going all the way back to March. Now, context is important here because, of course, we just got done with a 3-day sell-off on Wall Street. So after today's rally, we're only making up for about half of those losses thus far. Nevertheless, it is good to see that the bears aren't going to be able to completely control the narrative as we head into the holidays here at the end of the week. So we'll take a look at all that and see what it means for our postures. We do have a little bit of a posture shift in a couple of cases. And then we'll get into the trade application example later on in class where I wanted to focus on a sold put opportunity. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's December 21st, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, go down below in our description area, and make sure you're signed up for our email distribution list. We're also heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on those Market Outlook related tweets. And then last but not least, we do have a presence over on Facebook as well. Feel free to join our group at that web address you see embedded in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got chart 6D pulled up here in front of us for those of you that are premium members and following along at home. This particular chart will show us kind of a different visual whenever we have an extreme day in the market, whether it's an extreme up day or an extreme down day. And as you can see, we've got this histogram kind of in the middle of the chart that is kind of defined by this kind of black bold line that you see here representing the zero line, and then you have some green and red bars on either side of it. When they're green bars, as we see today, that means that was an up day for the market that particular day, and then how tall the bar grows shows you how big of a day it was compared to other days in the market. And as I mentioned there in the intro, other than this day that we saw right here, which would have been December 7th, today's bar is as tall as all of the rest of them on the board until we go all the way back here to March 4th, it looks like. So those towering skyscrapers to the upside, of course, feel good on a one-off basis, but as I mentioned here previously, unfortunately, this is just a quick little snapback rally to make up for part of the losses that we just got inflicted here in the last 3 days. You can see up here those 3 straight sell-off days on the S&P 500 and kind of what they look like down below here as well, with 2 out of those last 3 days with at least a 1% pullback there. So the S&P 500 was up 1.78% today, which again is a good day. But if you were down at least 1% 2 days in a row, and then your follow-up day was up 1.78%, you still haven't made up for those losses just over the last 2 days yet. So in other words, let's not get overly enthusiastic about this particular rally here until we start to see further stabilization on the charts. There's probably still a lot of choppiness in front of us, just like we've had to get used to here over the past month or so, where trading conditions have been a little bit more difficult because you're swinging back and forth a little bit more violently. We did see the VIX fall today as well. Remember, that's fairly typical. Whenever the S&P 500 goes up, all else being equal, the VIX likely goes down. And in this case, we fell back down to about 21 on the VIX. Remember, it was only a few weeks ago we were as high as 31 on the VIX. So we've actually fallen quite a bit in volatility at a time when the markets have largely just kind of gone sideways. So, in other words, if you're looking to hedge your portfolios by buying puts, they're a little bit cheaper right now than you would have been able to find just back there at the beginning of December, despite the price of the S&P 500 being approximately the same as back then, which is a little bit odd. You don't see that a whole lot. Anyway, let's go ahead and also take a look at some of the breadth measures under the hood, so to speak. And we'll start with kind of getting an index watch here on the S&P 500. And you can see 424 stocks out of the S&P 500 closed higher today, with only 79 closing lower. So it was a very strong advance for the bulls. It wasn't just in a few areas of mega cap tech or something like that. This was a broader advance across the board here today, with a lot of participation across various sectors and industries. So if you were to turn that into a percentage, that's about 85% of the market was finishing higher here today. So a good day. Again, we're not going to make too much of it, because we try to have to remind ourselves where we came from, and we want to keep with an even keel. We recognize this is generally a more bullish time of the year, but we also recognize that so far in the month of December we really haven't seen much of that bullishness. So could this be a year like we saw in 2018, where we spilled over into the Christmas holiday? We will see here as we go forward, but today was at least one day that gave you a ray of hope if you're a bull, I suppose. Another way to kind of get a sense of breadth is by looking at the heat map. And so let's take a look at the S&P 500 here on the heat map to try to get a sense of where we had patches of strength and or weakness. And as you can see, we had a pretty strong green session here. We have a lot of green on the board in front of us, including from the major players out there. Remember, the larger the squares and the rectangles, the more influential they are on the overall returns of the S&P 500, because the S&P 500 is a market cap weighted index. So a stock like Amazon, which was up 2% today and is a $1.7 trillion company, is influential. A stock like Apple, up nearly 2% today, as nearly a $3 trillion, is influential. A stock like Microsoft, which is up 2.3% today and is a $2.5 trillion company, is influential. A stock like Tesla, which is just below $1 trillion market cap right now, but was up 4% today, that is definitely impactful. And then you've got your alphabets up here with the two different share classes, but they are obviously very important as well, and they were up over 1% today. So in other words, you can see that today from a mega cap tech perspective, remember, those are some of the areas that had been struggling in recent weeks. And again, I'm not going to make too much out of one day here. One day does not make a trend. But, if we are ever to get some sort of a more meaningful reversal, it does have to start somewhere. So we have to acknowledge that as well. And so who knows, maybe today is kind of a turn in the right direction. We'll find that out together. But, we do have some good green on the board for once, right? More times than not, when I've been showing you this heat map in recent weeks, it's been more of a bearish conversation. Today was obviously a tilt towards those green squares and rectangles, more bullish, all things considered. We did have some patches of red out there, and it was kind of a flip-flop from what we've been recognizing in the markets in recent weeks, which is the defensive areas like your utilities in the lower right-hand corner here, and then you've got your consumer staples kind of in the lower right-hand portion as well, and then some of your key mega cap pharma companies up here at the top, along with some of those telecom stocks like Verizon and what have you. Those are generally perceived as the more defensive areas of the market that tend to do a bit better when the market is nervous and scared. And so they had done quite well in recent weeks on a comparative basis. But today is one of those reversal days where the money started flowing back to the cyclicals and came out of the defensives. And whether that's just one day or not, who knows? But it is about the exact opposite of what we saw more times than not in the last couple of weeks. So, and it makes sense, right? When the markets have a bit more enthusiasm around them and a willingness to take on risk, money's got to come from somewhere, right? And it's oftentimes rotating within the sectors themselves. So, market participants here today felt maybe a little bit more comfortable with things. I know, the Omicron virus or variant is, of course, front and center when it comes to economic conversations these days. And I think there is this sense out there that a lot of folks are coming down with this virus. I happen to notice on CNBC that both Jim Cramer and Carl Catanea have it, in addition to a bunch of politicians and others out there that it seems like every day we're seeing or hearing somebody else catching this. But from all reports that we've been seeing thus far, it suggests that the virus isn't nearly as lethal as the first COVID strain that we all experienced back in the spring of 2020. So it's no fun for anybody to get sick, don't get me wrong, but it does seem like the kind of the response of our bodies and our society collectively, perhaps it's because of vaccinations, who knows, but in general, it just doesn't seem like we're taking this variant as badly as we had before. And so maybe a glimmer of hope there, right? As we kind of recognize that, yeah, a lot of us get sick with the flu every year too, right? And we get past it and we move on, and it doesn't have to result in a lockdown of the economy or something along those lines. So it's possible that, investors are starting to kind of turn a page there a little bit in how they view this particular variant that seems to be running rampant through our country right now. But all in all, a great looking heat map here today with a lot of green there, looking like a Christmas tree all lit up there for us today as bulls. Let's get back on track with our more typical charting routine now and take a look at our market forecast charts, which for those of you following along at home will be chart 4B. And so as we're pulling this up here, I wanted to show you that we did have a couple of posture changes here today, as I alluded to in the intro. First of all, on the S&P 500, which is the chart in the upper left, and the NASDAQ composite in the lower left, both of those you can see change the background colors from pink to green. Now notice those two different charts in the last 2 days actually represent the 4 different possible shadings that exist out there. Most of you are aware of that, but in case you're newer to the video, this is a lighter pink that you see up here on the S&P 500 as an example, and you can probably tell just by spot checking it with your eyes that the pink down below on the NASDAQ is a little bit darker shaded. And likewise with the S&P 500's green that it went to today, it's a little bit darker than the lighter green that you see on the NASDAQ composite. And so the differences between those kind of 4 different shadings are determined by where is the green line on the market forecast technical indicator. If the green line is rising between 20 and 80, as it is on both of these charts right now, the background color will be green, as it is on both of those charts right now. But what makes the one on top be a darker shade is the fact that we are still above the 50th percentile on the market forecast for the S&P 500 right now, whereas down below here you can see the green line or the intermediate line, however you want to phrase that, on the NASDAQ composite is not above that indicator's 50th percentile. It's way down below here, still pretty close to the low reversal zone as a matter of fact. So in other words, we're not going to be as trustworthy about an actual bullish posture on the NASDAQ composite as we are perhaps on the S&P 500. And that should make some sense to you as well when you just eyeball the chart, because you can look at where the candle is right now on the S&P 500 and notice that we basically closed at the highs of today's session. We are also at the 30-day moving average itself, whereas down below we have the NASDAQ composite with a little bit of an air pocket there by the 30-day moving average. So in other words, we still have a bit more weakness in the NASDAQ composite versus what we're seeing up here. You'll notice, as I mentioned in the intro, that all 4 of these charts do have red moving averages right now, signifying that we do still have price below falling moving averages in all 4 of our charts cases. So although the postures of the S&P 500 and the NASDAQ composite have switched to bullish, there's still this kind of feeling of a path of least resistance to the downside for a lot of these indices at this moment in time. Of all of these charts, I would say the one that looks the most bullish to me is the S&P 500, because there you do have the strongly bullish posture, and you can see that with just another little skosh higher, we would have actually been trading above that moving average today. So we just didn't quite get there, but if the markets are up tomorrow, in all likelihood, the S&P 500 would then be above its moving average. You can also look at the chart itself and kind of just get a sense that that feels and looks to me like it's been heading sideways in the last, let's call it, month and a half or so. Whereas when I look at these other charts, I do sense a more decided downward tilt towards them. So of these 4 major U.S. equity indices, I would say that our leader right now is the S&P 500. The other charts still got a little bit of work to do with them. One thing I should point out as well is we have a fairly rare trade signal example in the chart in the lower right-hand corner, and that's your Russell 2000. And what we have here is what's known as a bearish intermediate confirmation signal. Remember, you've probably heard David and I discuss the bullish intermediate confirmation signal many times throughout recent years because markets have largely been bullish. And remember, on the bullish intermediate confirmation signals, it's effectively a buy the dips signal. So when we have what's known as a bearish intermediate confirmation signal now on the Russell 2000, some of you that are a little bit more aggressive might think of it as a sell the rips signal instead of buy the dips. And you would just kind of turn those that mindset of that indicator upside down from the bullish to the bearish side of the equation. In other words, in this case, notice that the green line on the Russell 2000 is still in the lower reversal zone, suggesting that that is still a strongly bearish posture. And at the same day, we have the red line in the upper reversal zone, basically saying we've had a nice rip higher, but we continue to have the intermediate bearish trend in place at this moment in time. So if you are out there looking for short selling opportunities, would you rather short when it's breaking down to new multi-month lows like yesterday, or would you rather short when you have a little bit of a reaction move like we have here today with a little bit of a dead cat bounce, right? And your entries, of course, would be better if you waited till today. Now, without a crystal ball, you'll never be able to nail that perfectly, but that's kind of the mindset. Are you more of a breakdown trader, or are you going to wait for better pricing? And for those of you that have been waiting for better pricing to put on new shorts, then of course, waiting until a day when the market, in this case, the Russell 2000 was up basically 3%, 2.95% to be exact, you're going to get better pricing if you waited to put on your bearish trades till today. So kind of a rare example there of a bearish intermediate confirmation signal, a sell the rips signal in that particular case. Notice that we still have that strongly bearish posture as suggested by the dark pink background color there. With the Dow Jones Industrial Average up above, it's that lighter pink background color. And again, the difference there being the green line in this case is above the 50th percentile. So while the green line itself is falling, because it hasn't fallen past the 50th percentile yet, we still consider that weakly bearish, not strongly bearish. In the case of the Russell 2000, it's been strongly bearish really since the 13th of December. And even before that, it was strongly bearish as well. So it just had kind of that 3-day rally along the way where that went away. But otherwise, we've been strongly bearish on the Russell 2000 for the better part of the last month. And even prior to it going to that dark pink shading, it was that light pink shading for several days prior to that. So really, since this moment in time on November 16th, we've been bearish on the Russell 2000 with the exception of those 2 or 3 days right there that we had that quick little pop higher. So this has not been a great place to kind of be rolling the dice and looking for your bullish opportunities. And for those of you that have been waiting patiently for a better entry, maybe that's your signal to get into some bearish trades on the Russell 2000 here. So that continues to be our weakest link, is the Russell 2000, and our leader at this moment in time, I would say, is probably the S&P 500, at least from what my eyes see. Let's go ahead and take a quick peek here at the internet. I always like to get a chance to say thank you to those of you that help support these market outlook videos. The last time I did the video on Thursday, 93 of you came out and said, you know what, Brandon, we liked that. We want you to do it again. And as I always tell you, as long as we're getting up and over 100 likes, I don't think twice about doing the video. Once we're below 100 likes like we were today, then I kind of just have to look at what my schedule is like and whether I can fit it in or not. So if you want us to be able to do these videos as often as possible, do your best to help support them. It doesn't cost you any money. All it takes is 5 seconds of your day, and there's 4 different ways that you can access the tweet in question. You can find it pinned to the top of our timeline on Twitter. You can find it right here underneath the video that you're watching on the website by clicking into this little Twitter widget area and just clicking like there. You can also find the link in the description area of the YouTube video for those of you that watch it directly on YouTube. And then you can also find the Twitter link in question on the emails that we send you out for the notification. So whatever of those four ways to go about clicking like you prefer, feel free to do any one of those, and that'll all get you to the same place. But we appreciate that. It helps get the word out about our organization to a much wider audience than we would be able to on our own. So if we can educate you along the way with some free videos and you can help us along with some promotion, then we can scratch each other's back and we don't have to worry about anything. If one of those sides kind of falls off, then naturally you can understand where we've got a lot of other things to do during our day as busy business owners as well. So again, thank you to the 93 of you that stepped up for us the last time around. Also, earlier today, I taught my dividend growth investing class. It was actually my final DGI class of 2021. And it was a rare class where we actually evaluated 4 different securities and analyzed 4 different securities. Typically, we don't do that many in one class, but since I'm not going to be in class next week, figured let's do a few more here today. So if you didn't happen to catch that mega episode and you're a plus or a premium member, that has now been posted to our calendar. So make sure you check that out as we kind of wrapped up our portfolio here for 2021. And it's been a great run of things for DGI class here recently as the market has kind of drifted towards more of those blue chip types of companies. So we've seen some really good success there, and my students have done a phenomenal job as they typically have done. Also, David taught his directional option strategy class earlier today. Tomorrow morning, I've got factor-based swing trading at 11 a.m. Eastern Time, and then David will be teaching his options inventory trading class at 2 p.m. Eastern Time. So lots of great content heading your way. Also, wanted to mention here real briefly that I did update the trading plans that I use for my top-down trend trading class here over the past week. So in case you haven't been attending that Monday class of mine recently, you might not be aware that we have some new risk management rules that we've been implementing recently. And so the trading plan has now been updated to reflect those. So if you are a premium member, you can access those trading plans by hovering your mouse over the Tools tab and then clicking on Premium Resources. And then as you scroll down a little bit, you'll eventually find my trading plans there. So be aware of that as well, in case you hadn't heard that yet. Moving on now to the sector selector. Wanted to show you that we had quite the upheaval here. Now, I kind of hinted at this 1 week ago. I remember I brought up that chart 1E, and I said, unless we see some sort of major change in the market, expect a whole bunch of ranking switches, the next time I do the sector selector, and indeed that did happen. In fact, this was a very rare week where we only had one sector that kept its prior week's ranking, and that was communication services. It was dead last once again. But other than the 11th place, every other ranking from 1 to 10 was a different place than where that sector was just the week before. You do not typically see this type of upheaval, but it does go to show you that the market was getting very concerned here more recently and has been switching its attention towards more of the defensive areas of the market, like real estate, like utilities, like consumer staples, and even healthcare caught a little bit of a bid there towards the bottom. And market was rotating out of some of the more cyclical areas like industrials and energy, and even some of the more compounding growth types of stocks like your tech stocks and what have you. So today, of course, was the opposite day, right? Where we're back kind of on the risk-on mindset, but we'll see if today was just a one-off day or whether we're going to have a whole bunch more shift on the sector selector in the weeks to come. Right now, all else being equal, I assume that we'll kind of hold these defensive positions a little bit, into the near-term future. Beyond the next few weeks, who knows? But right now, it does feel like there's some decent trends that are being established within some of these more mundane areas of the market. In fact, we bought a consumer staples company in my top-down trend trading class On Monday, we actually bought a Dividend Aristocrat company. Usually we reserve those for my DGI class when they're selling off. But in this case, we actually bought a Dividend Aristocrat company as a momentum stock in my top-down trend trading class, because a lot of those charts have really started shaping up quite nicely here recently. Also, I wanted a quick mention here on Twitter. Some of you caught this already, but one of our clients, Claire, has been nice enough to track the sold put trade ideas that I've been doing lately. And that includes both the sold puts that I do here in the Market Outlook videos, and also all the sold put trades that I do in my Monday afternoon options for long-term investors class. And we have now gone 115 trades in a row without a loss, all wins across the board, and that stretches out over 22 months. Now this last round, as some of you heard me mention in a video or two in the past, was not nearly as easy as a lot of our other months have been. In particular, Philip Morris was way in the money for us during the life of our trade, but because we stuck to our guns, and in that particular class, we kind of make the commitment to wanting to buy high-quality companies at cheaper prices. We held Philip Morris sold puts like we did with our other trades, and wouldn't you know, we had a swing back towards the consumer staples in terms of rising stock prices in recent weeks, and we went from being well in the money to out of the money once again, and our win streak stayed alive. So again, thank you to Claire for tracking that information for us, and congratulations to all of you who have participated in at least some of those sold put trades along the way, which we've done a lot of them here in this video as well. I've lost plenty of trades for swing trading and trend trading and other types of trades out there, but at least with the sold put trades, we've had a really nice win streak here, and that stretches almost 2 years at this point. We'll see if we can keep it alive. A little bit of a hint there, or a foreshadowing, because I will be showing you a sold put trade idea at the end of today's video. Let's get back on track with some more chart reading now, and let's do some 12 grid analysis. And so we're going to look at the asset class 12 grid now. And this is chart 5A for those of you that are premium members following along at home. And you can see that the bottom rung, we now have a bit more green than we did when I did the video last on Thursday. Remember, that was mostly red at that particular time, but a couple of these areas, including oil, remember oil is a little bit more cyclical, it's kind of a risk-on mindset there, has come back to life. And we've seen bonds sell off to a small degree. Notice up here, TLT sold off here today, and it actually followed up a pretty big sell-off day yesterday as well. And so when bond prices are falling, remember the inverse typically happens to yields, which are rising. And when yields are rising, it's usually a more bullish feel towards the overall markets at that time. It's a sign of a hotter economy when yields are rising. And so you can see that we had this nice push higher on TNX, and we ended today's session on the 10-year at 1.48%. However, we remain just a hair below that falling moving average. So although we got the weekly bullish posture back according to the market forecast, we are still below that moving average. So we're kind of in no man's land right now when it comes to interest rates. However, at least we got a 2-day reprieve here after we had a pretty substantial sell-off in rates in the last couple of months here, as you can see. And so since we had more of a risk-on type of a day today, it shouldn't be a surprise that oil was also up. Oil was up over 3% today. Similar to interest rates, we've had a good rally over the last day and a half or so, but we remain below that falling moving average. So we have the weekly bullish market forecast posture, but still below the falling moving average. So no man's land there as well. And we're not done with that conversation because we're still in no man's land with gold as well. Now, gold's a little bit different than oil because gold actually sold off today, not by much, but this was the third straight down day for gold. Remember, it was a couple of weeks ago I did that Agnico Eagle gold mining trade, and we caught that nice little move right after the FOMC meeting and got in and out of that trade quickly. So we didn't have to suffer through any of the pullback in gold or gold miners here in the last 3 days. So I am thankful for that. But where we stand right now with GLD is kind of no man's land because, again, weekly bullish posture combined with price below a falling moving average. So we have kind of conflicting reports. We still don't know if it's bullish or bearish. We're kind of waiting for a breakout in either direction there. And as I've been kind of mentioning to you guys in the last few weeks, I wouldn't necessarily mind GLD as an iron condor trade. Now, since I've been saying it for the last few weeks, of course, had you been putting the trade on immediately, you'd have been on easy street at this point because we have effectively just gone sideways over that time period. The longer I keep saying it like I have, the greater the chance is that that iron condor might eventually fail because, you know, a chart doesn't go sideways forever. Eventually, there will be a break either up or down. But right now, we're still kind of in that holding pattern. And it just doesn't want to seem like it wants to break one direction or another. So keep your eye on that possibility there as well. US dollar has been strong for quite some time. This is probably the strongest chart on the board here in front of us out of this 12 grid right now. It's just been consistently plotting higher. And remember, a strong US dollar environment isn't necessarily a great environment for stock investors. Remember, stocks are priced in US dollars, just like loaves of bread are. And so when the dollar is strong, you tend to have like a lot of your mega cap international companies like your Coca-Colas and your Procter & Gambles, those types of companies, maybe doing a little bit worse than average. Right now, they've kind of been bailed out because of this drift towards defensive-natured companies. But if you think about other international companies that do a lot of business overseas, a strong dollar makes it a little bit harder comparisons, right? Like if you're earning most of your money in euros and then you got to convert that back into a strong dollar, so a weak euro versus a strong dollar makes it appear like your earnings per share in dollars is kind of underwhelming compared to an exact similar quarter where the dollar was weak. So anyway, it doesn't have to derail a major market advance, but in general, I do find that being bullish in the overall stock market is a little bit easier when the dollar's weak, and that's kind of the opposite of what we've had here in the last 3 months or so. I should point out that foreign bonds did crack below their moving average today, just like we saw with TLT. So both of those back below their moving average. But notice the exact opposite over here on high yield bonds. Some of you guys have heard me make this comment in the past that there is a fair bit of correlation between high yield bonds and oil prices. Remember, high yield bonds are effectively corporations that can't really turn to more attractive financing areas, and so they have to turn to the junk bond markets where they raise capital at awfully expensive prices. And a lot of the companies that have struggled in recent years are oil companies, and so you get the sense that when oil rallies like we see today, that the oil-related corporations that make up a big chunk of the high-yield bond market are on a little bit more solid footing, and that's being reflected in the high-yield bonds as well. So anyway, they got a little bit of a lucky break there today, I suppose, when the rest of the bond market really kind of sold off. Notice that we had big rallies in the foreign markets today as well. The developed foreign markets up 1.1%, and the emerging foreign markets were up 1.7%. However, notice the background colors of both of those charts are still dark pink, telling us that we do have strongly bearish price action or postures there. So again, this is a little bit of a reflex rally. Even if you look at these two charts and then just compare it to the S&P 500. Now granted, remember the S&P 500 does look better than the 3 other major US indices, so it's kind of unfair to compare these foreign stock markets to the best in the US. Nonetheless, it does give you a sense that the foreign markets have struggled mightily. You think about stocks like Alibaba and some of those Chinese companies, Didi and those companies that have been getting blitzed in recent months. That's not really helping the emerging markets world, and even the developed foreign stocks really haven't been showing much interest in being bullish here recently. So, of those three kind of different areas, it does appear that the U.S. markets are stronger than the stock markets that we are seeing internationally, at least at a high level. Let's take a look at sector analysis now. This will be chart 5C here, the U.S. sectors 12 grid. Remember, this is the market cap weighted version of it, so it's a little bit different than what I teach my students in my top-down trend trading class when we're looking at equal weighted analysis. Nevertheless, there is a fair bit of overlap there. And you can see here that we do have 4 green charts on the board. 3 of them are obvious ones, 1 of them less obvious. So let's start with the obvious ones, and those are the ones on the bottom rung here. You can see that healthcare, consumer staples, and real estate are all that dark green background color. Now, keep in mind, the staples were actually down today, not by much, down 0.13%, but nonetheless, they were down for their 3rd consecutive day. Despite seeing that, you still have that strongly bullish posture. That should be obvious because you had that big breakout there in consumer staples here along the way. We talked about that a little bit here on Thursday when we were talking about that vector trade. Anyway, as you can see here with healthcare, they were kind of a similar situation, maybe not quite to the same degree, but you had this really nice move where you had most of the days during that kind of 2-week period to the upside. So we have a little bit of a give back here, and who knows, maybe these are setting up as nice bull flag setups, right? And then you kind of have the same thing over here on real estate as well, where you were zooming not quite as consistently perhaps as the other two that I mentioned, because you had a couple more red days there along the way. Nonetheless, the same type of feel to the chart where you went from being below the 30-day moving average to well above it. Notice the difference in that kind of philosophy versus all of these other charts up here, right? Hardly any of those other charts look the way that the 4 charts on the bottom, what we would classify as the defensive sectors, have looked. All of those defensive sectors at the bottom look great, where they were breaking out from below their moving averages to well above it, and now here in the last few days have had a little bit of a pullback to take a breather, but their uptrends are still in place. Now, in the case of utilities, you can see that the posture has shifted to weekly bearish, but because we're still above that rising 3-day moving average, I'm not sure how much I'm going to read into that. I still think that the defensive sector chart trends do look strong at this moment in time. And I take that back. I said there were 4 green charts. I happened to overlook the energy one here. The other one that I was looking at was communication. So both communications and energy both have weekly bullish postures right now. Neither of the charts look particularly appetizing to my eyes. Communications is a little bit of an oddball because remember, communications was doing so poorly. It was basically like dead last in its ranking for a long period of time, but it's actually stabilized reasonably well here on a comparative basis in the last, let's call it week and a half or so. Remember, that was not the case previously. Communications was falling off of the map and actually leading the market to the downside. You can't really get away with saying that anymore. Right? If you were to look at something like the financials, notice that yesterday the financials at the low point of their session would have actually brought you back to nearly 3 months ago. And even the industrials don't look particularly appetizing there, and even the discretionary is taking you back at least 2 months. And we don't really get a chance to say that about communications. Yes, communications was down yesterday with a lot of the other market, but it is still well above where its lows were just on December 1st. So, again, we're not going to make too much out of this because it's still below its falling 30-day moving average. But if we ever get a legitimate trend reversal to take place, we start seeing little signs on the charts of that. And maybe, just maybe, we're starting to see a little bit more bullishness creep into the communications area here. So we'll keep our eye on that possibility. All the other charts are bearish, and the ones that are the strongly bearish charts are the financials, industrials, and discretionary. Those are the ones with the dark pink background colors there that I was pointing out to you a moment ago in terms of, uglier charts that are bringing us back several weeks or even months in some cases, and kind of giving up a lot of those gains along the way. So those are areas that are kind of losing steam during this current moment in time. All right, let's go ahead and get into our trade application example now. And I'm going to start by pulling up chart 2A. Now, as I've already mentioned, this is going to be a sold put opportunity. And remember, the trades get done while the market is open. And all of you who are premium members get alerted to when these trades get done when I send out the notifications via our Telegram app. Gives you a heads up before everybody else who's going to be watching the video for free later on that night on YouTube. So make sure you're taking advantage of those resources if you are one of our premium members. But anyway, the chart that I'm going to pull up here is what the traders used to call glowworm, GLW. It actually stands for the old Glowworks. As most of you are aware, Corning is a company that has kind of redefined itself many times over its history. It's actually one of the most innovative companies you'll find out there that started off as kind of a dish-making company and has been converted into one of the most high-tech companies that you'll ever stumble across, and very important in today's world, especially with all of the Gorilla Glass and ceramic glass and all that kind of stuff that they use for iPhones and other touch devices that are out there these days, in addition to all the fiber optic work that they do for the internet and a lot of other things. They actually have like 4 or 5 major divisions. But as you can see here, we've actually had a pretty substantial pullback in Corning recently. We did break to multi-year highs here earlier in the year when it came all the way up here to close to $47 per share. And since that time has actually given up about $10 per share along the way. So that's a pretty healthy give back there. And many of you are aware of this chart, but in case you're newer, this is the chart that I use for my dividend growth investing classes or my long-term classes. And it's a way for us to judge a company's appeal currently exclusively through its dividend yield and comparing that to its historical dividend yields. And so the key takeaway that you'll want to know about this dividend stair-step chart is that when the stock is in the blue zone, we find it more attractive for long-term purposes. When the chart is in that orange zone up above, it's less attractive to us up at those levels. So, we try to remain patient and wait for pullbacks on high-quality merchandise as kind of longer term oriented folks. So this one is back in the blue zone here, and in fact you can see that there's this little green dot that showed up under last week's bar, and that little green dot is a market forecast oversold cluster signal using a weekly candle chart. And remember, those signals are more rare than when you hear David and I talk about the cluster signals on the daily candle charts. Oftentimes you will find that those little green dots will start showing up at times when the stock is about ready to find a bottom. Not always, but it can be a useful guide. And you can see back here, we had a little green dot show up back in April of 2018, and that was right around the time when Corning turned around and went from about 25 bucks all the way up here to 36 bucks in the next half of a year. And then we also had this other period of time over here where we had a whole bunch of those little green dots showing up. And while that one didn't work quite as good from a timing perspective, it would have still been a good time for a long-term investor to be kind of establishing a position down there as the stock was trading below $20 per share, of course trading at 36 these days. So this is a company that has a reasonably strong dividend at this current level at 2.65%. Obviously much better than the S&P 500's yield of only 1.3% here currently. You also have a reasonably long history of raising the dividend over there at Corning. It's not an aristocrat, but has done so for at least the last 10 years plus. So that's a good thing there as well. Anyway, what we opted to do here today was to sell a put on Corning. And what I did was I sold the February 31 puts. And so that would bring our eventual cost basis down to about this area right here. Typically, I'm gonna target the 20 to 60 day window when I'm a put seller, and the Februaries are now within that window, right? You could also do the Januaries if you wanted to, so everybody's a little different there, but I chose the Februaries in this case. And then I also tend to focus on a 1% return on risk or more. At least that's the hope. Remember, if you're kind of doing these types of trades once a month and you're getting an extra 1%, that's about a 12% tack on at the end of the year. So some of you might be comfortable with that. Others might demand more. Some of you might want less because there's less risk. So everybody has to kind of fall in a different line there depending upon their own mindset. But in general, I find that to be kind of a comfortable zone when I'm looking to sell puts on high quality dividend stocks like this one. Now you'll notice that there's this other label up here that says the 3-year dividend yield level is at $32. It's in yellow, so I know it's harder to find up there. But you can also see it on the chart right here. There's this little 32 in the yellow kind of bubble right there. And so that's where if you were trying to seek out a 3% dividend yield, the stock would need to be trading at. And so if we were filled at 31, again, the trade's already been done where we've sold the 31 put in the month of February, but whether we actually get the stock at 31 depends on whether the stock will keep on falling or not. If it does fall below 31, then our cost basis will be 31, and at that point, the dividend yield would be well above 3%, which typically is an attractive time to be a buyer of Corning. You can see that it was trading well above a 3% yield here during the coronavirus fallout, but as it recovered, it eventually got above that yellow stair-step line there. It also touched that 3% yield briefly back here in 2015. But in general, if you're somebody that's buying Corning with a 3% yield, you're usually setting yourself up for reasonable long-term opportunities there. And so that's part of the appeal of this one as well, is that by selling the 31, we could get our 3% dividend yield. Now remember, for those of you that are newer to the idea of selling puts, it's effectively a bullish trade idea where you're trying to buy a stock at a lower price than where it's currently trading. So rather than buying Corning here at 36, I want to buy it at 31. And so I'm doing what's known as a sold put, and I am taking on somebody else's risk, whoever's buying that put from me, and I'm assuming their risk, but in return, I receive a premium up front. So if the stock does not go down below 31, that premium, that credit that I received in my account today is mine free and clear to keep. If it does go down below 31, then I am then on the hook for buying those shares at that price where I desire to be a long-term investor in this company. Another thing I did want to point out about Corning here real quick is that it does have a somewhat favorable swing trading chart as well. It's not the driver of this trade idea by any means, but at least is worth pointing out from an educational perspective. So here's Corning on chart 3A. And you'll notice that the background color just shifted to blue here today from pink yesterday. What that's telling us is that the near-term line now has a bullish posture here. Yesterday it did not. We had this big sell-off day yesterday. Nice long lower shadow, I would add, yesterday as well. We also got that today. Some of you are familiar that when we get those long lower shadows at what appear to be support areas, that can be a sign that the bulls are starting to step into this particular security and forming a new bottom. And you could probably get away with saying this is a bit of a double bottom from where it was trading back here at the end of October. Its low price was $35.24. Yesterday's low price was $35.37. So basically within 15 cents of that low, but we were able to bounce that stock before it breached to a new low there. And we might end up looking back at that and saying that was a double bottom at around $35 for Corning. You can also see that we have a bit of a bullish near-term divergence signal. Notice we have a trough in the blue line here on December 10th, and then we have a follow-up trough here just yesterday on the 20th, and of course that follow-up trough is a higher low, right? This is a lower low, that is a higher low. Now notice what's happening with the price candles along the way at those two same dates. Up here is December 10th on a price candle, and here is December 20th on a price candle. Obviously, prices continue to go down significantly at a time when the underlying indicator improved its own prospects. And so that might be yet another reason to be somewhat bullish on this one, despite it not really having a whole lot of relative strength yet. Okay, so that's what I had for you here today. Of course, if you need the fill prices and all that kind of stuff, check your Telegram app there if you're a premium member. But otherwise, I appreciate you checking out this free video here tonight. If you got value out of it, I ask one and only one thing out of you. It should only take you 5 seconds. Just click like for me there on Twitter. I hope to be with you here this upcoming Thursday as well. And David should be back with you tomorrow. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.